Question 691. A person operating a business on a property he is leasing holds A leasehold estate, B freehold estate, C less than freehold estate, D both A and C. Correct answer is D both A and C. A leasehold estate is the legal right granted to a tenant by a landlord to occupy and use a property for a specified period in exchange for rent. Since the person is leasing the property, they hold a leasehold estate. A leasehold estate is also known as a less than freehold estate. This is because the tenant does not own the property outright. They don't have a freehold interest. This is because the tenant does not own the property outright. They don't have a freehold interest. Their rights are limited by the terms of the lease agreement and are for a defined period. Freehold estates, on the other hand, involve ownership interests, like fee simple or life estates, that are for an indefinite duration. A freehold estate signifies ownership of the property, which the person leasing does not have. Therefore, a person operating a business on a leased property holds a leasehold estate, which is a type of less than freehold estate. Question 692. The following are sources of demand for mortgage funds, except A. Home construction, B. New business, C. Federal home loan banks, D. Land development. Correct answer is C. Federal home loan banks. Demand for mortgage funds comes from those who need to borrow money to finance real estate purchases or development. This includes individuals buying homes, developers building projects, and businesses acquiring property. Home construction creates a demand for mortgage funds as builders and potential homeowners seek financing for new residential properties. New business ventures often require financing to purchase or lease commercial real estate, thus contributing to the demand for mortgage funds. Land development projects necessitate significant capital, often obtained through mortgages, to finance the acquisition and improvement of land. Federal Home Loan Banks, FHL banks, on the other hand, are a source of funds for mortgage lenders. They are government-sponsored enterprises that provide liquidity to member financial institutions to support housing finance and community investment. Banks and other lenders borrow from FHL banks to have funds available to lend to those who demand mortgages. Therefore, while FHL banks play a crucial role in the mortgage market, they are a source of supply, not a direct source of demand for mortgage funds. Therefore, while FHL banks play a crucial role in the mortgage market, they are a source of supply, not a direct source of demand for mortgage funds. Question 693. When a sublease is made, the following occurs. A primary responsibility for paying the rent remains with the original tenant, sublessor, B. Primary responsibility for paying the rent is transferred to the new tenant, sublessee. C. The original lease is terminated by the sublease, D. Possession of the property is transferred to the lessor, but for less than the full term. Correct answer is A. Primary responsibility for paying the rent remains with the original tenant, sublessor. When a tenant, the sublessor, subleases a property to a new tenant, the sublessee, the original lease agreement between the landlord, lessor, and the original tenant remains in effect. The sublease creates a new, separate agreement between the original tenant and the sublessee. The original tenant is still obligated to pay rent to the landlord according to the terms of the original lease. The sublessee pays rent to the sublessor, who then uses those funds, hopefully, to pay the landlord. If the sublessee fails to pay the sublessor is still responsible to the landlord. While the sublessee pays rent to the sublessor, they do not have a direct contractual obligation to the original landlord. A sublease does not terminate the original lease. It creates a secondary lease agreement under the umbrella of the original one. A full assignment of the lease, with the landlord's consent, would typically be required to release the original tenant from their obligations. In a sublease, possession is transferred to the sublessee, not the original lessor, landlord. The sublessee has possession for a period that is less than or equal to the remaining term of the original lease. Question 694. In the wake of the widespread savings and loan failures of the 1980s, a law abolished the Federal Home Loan Bank Board and created the Office of Thrift Supervision to supervise savings institutions. The new law was called A. The Savings and Loan Rescue Act, SLRA, B. The Thrift Authority, C. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA, D. United States Savings Bank Central Command. Correct answer is C. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA. United States Savings Bank Central Command is not a recognized entity within the context of United States financial regulations or the savings and loan crisis of the 1980s. The Thrift Authority is a somewhat ambiguous term, as it isn't the official name of a single, specific entity. However, it most likely refers to the Office of Thrift Supervision, OTS. United States Savings Bank Central Command is not a recognized entity within the context of United States financial regulations or the savings and loan crisis of the 1980s. It sounds like a potentially fabricated or misunderstood term. There is no record of a federal agency or regulatory body with that specific name. In response to the 1980s savings and loan crisis, the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIREA, was enacted. This law eliminated the Federal Home Loan Bank Board and established the Office of Thrift Supervision to oversee savings institutions. FIREA was a comprehensive piece of legislation enacted to address the savings and loan crisis, overhaul the regulatory framework of the thrift industry, and restore public confidence in the financial system. It brought about significant changes, including the creation of new agencies and the strengthening of enforcement powers. Question 695. The following written instruments are contracts, except A. Mortgage, B. Exclusive authorization to sell listing, C. Escrow instructions, D. Quitclaim deed. Correct answer is D. Quitclaim deed. A contract is an agreement between two or more parties creating obligations that are enforceable or otherwise recognizable at law. It typically involves an offer, acceptance, and consideration, something of value exchanged. A mortgage is a contract between a borrower and a lender where the borrower pledges real property as security for a loan. It outlines the terms of the loan and the rights and responsibilities of both parties. Exclusive authorization to sell listing is a contract between a seller and a real estate broker. The seller agrees to give the broker the exclusive right to sell their property for a specified period, and the broker agrees to use their efforts to find a buyer. It outlines the commission and other terms of their agreement. Escrow instructions are written instructions signed by the buyer and seller, and sometimes the lender, that direct the escrow agent on how to handle the funds and documents necessary to close a real estate transaction. They create a contractual agreement outlining the obligations of the escrow agent. A quitclaim deed is a legal instrument used to transfer whatever interest the grantor, seller, has in a property to the grantee, buyer. However, it does not contain any warranties or promises about the quality of the title being transferred. The grantor is essentially saying, "Whatever I own, I give to you." It doesn't create obligations or promises in the same way a contract does. It's simply a conveyance of interest, if any exists. Therefore, a quitclaim deed is a conveyance instrument, not a contract that establishes ongoing obligations between parties. Question 696. Acting on behalf of more than one party involved in a transaction is A. Illegal, B. Permissible, if properly disclosed and agreed to by the parties, C. Unethical, D. Renders the transaction voidable. Correct answer is B. Permissible, if properly disclosed and agreed to by the parties. This situation describes dual agency, which occurs when a real estate agent or broker represents both the buyer and the seller in the same transaction. Here's why it's permissible under specific conditions. 1. Disclosure. The agent must fully disclose their dual agency role to all parties involved, both the buyer and the seller. This disclosure must clearly explain the potential conflicts of interest and the limitations on the agent's ability to provide undivided loyalty. 2. Informed consent. All parties must give their informed consent to the dual agency, usually in writing. This means they understand the implications and agree to the agent representing both sides. Note that failing to disclose such a dual agency violates the real estate law. A transaction involving undisclosed or improperly disclosed dual agency can be voidable by the injured party, usually the client who was not fully informed or did not consent. However, if properly disclosed and consented to, it does not automatically render the transaction voidable. Question 697. Which of the following would not be paid by escrow disbursements? A. Hazard insurance. B. Real estate taxes. C. Mortgage insurance. D. Personal taxes. Correct answer is D. Personal taxes. Escrow disbursements are funds paid out by the escrow company at the close of a real estate transaction according to the instructions provided by the buyer, seller, and lender. These disbursements are directly related to the property and the transaction itself. The expense that would not typically be paid by escrow disbursements in a real estate transaction is personal taxes. Often, the initial premium for the buyer's hazard insurance policy is paid through escrow to ensure the property is insured from the moment of closing. Property taxes that are due or may become due are typically prorated between the buyer and seller and paid through escrow to ensure the correct party pays for their period of ownership. If the buyer is obtaining a loan that requires mortgage insurance, like PMI for conventional loans with less than a 20% down payment, or FHA, VA mortgage insurance, the initial premium or a portion thereof might be paid through escrow. Personal taxes, such as income tax or personal property tax on items not permanently affixed to the real estate, are the individual's responsibility and are not related to the real estate transaction or the property itself. Therefore, personal taxes would not be paid through escrow disbursements. Question 698. 4 persons own equal interests in a large vacant lot as tenants in common. One of the co-tenants decided to lease the property to a developer planning to build a high-rise apartment building. The lease between that co-tenant and the developer is A. Valid and binding on the other co-tenants. B. Valid, provided that the lease does not exceed 70 years. C. Invalid, as one co-tenant cannot obligate the other co-tenants for a lease of the whole property without their consent. D. Invalid, and not binding on the other co-tenants since land owned by co-tenants cannot be leased under any circumstances. Correct answer is C. Invalid, as one co-tenant cannot obligate the other co-tenants for a lease of the whole property without their consent. In a tenancy in common, each co-tenant owns an undivided interest in the entire property. This means that while they have the right to use and possess the whole property, they do not own specific, divided portions. Crucially, one co-tenant generally cannot unilaterally take actions that affect the rights and interests of the other co-tenants in the entire property without their consent or agreement. Leasing the entire vacant lot to a developer for a high-rise apartment building significantly impacts the other co-tenants' rights to possess and use their undivided interests. The developer would typically need to obtain leases or agreements from all 4 co-tenants to have a valid lease for the entire property. Question 699. Roof types include the following, except A. Gambrel. B. Mansard. C. Tudor. D. Gable. Correct answer is C. Tudor. Gambrel roof has a distinctive double slope on each side, with a steeper lower slope and a gentler upper slope. Mansard is a four-sided gambrel roof with a distinctive concave curve near the top. Gable is the most common roof type, with a triangular shape formed by two sloping sides that meet at a ridge. Tudor is not a specific roof type, but rather architectural style that often incorporates a variety of roof shapes, including gables, hips, and shed roofs. Therefore, Tudor doesn't denote a single roof style but encompasses various roof types within the broader architectural aesthetic. Question 700. A broker must retain copies of his real estate accounts and records prepared or obtained by her, including listings and deposit slips, for a minimum of A. 1 year, B. 3 years, C. 5 years, D. for the duration of his brokerage career. Correct answer is B. 3 years. California law requires real estate brokers to keep copies of all real estate-related accounts and records, such as listings and deposit slips, for at least 3 years. This retention period begins from the transaction date or the listing's expiration, whichever is later. This requirement ensures that records are available for inspection by the Department of Real Estate, now the Bureau of Real Estate Calbray or DRE, if necessary.